Imagine if you could make passive income and generate more than 20% return on your investments by co-investing in assets like furniture, bikes, batteries and electronics leased to big companies with strong balance sheets and business fundamentals. So first, let's try to understand what is leasing. It is nothing but a contractual agreement between two parties for regular payment to use an asset such as building, vehicle or any equipment for a specific period. For example, there's a company X that is aggressively growing and hiring 100 employees. Now, if the company wants to give 1 lakh rupees worth of MacBook to every employee, it will need to invest 1 crore rupees upfront, even before hiring begins. So now they can either burn their cash in hand or take a loan from a bank. And these options are generally not ideal because banks do not give out loans to buy physical assets like laptops without any collateral. And the funds raised from VC should ideally be used to grow the business and not to buy assets from it. Leasing assets is a great alternative for companies like this, who require loads of assets to operate their business and yet wants to remain asset light. The capital expenditure that they make on buying these assets can now be utilized for operational purposes, that is, converting capex into opex. Leasing also allows them to hyperscale their business. So this growth in leasing space has resulted in a new investment opportunity for retail investors, which is basically called as lease investing. Lease investing is basically a process of investing in the lease contracts of these companies. Here are a few things that you need to consider before investing in leased assets. Number one, residual value of the assets. Residual value is basically an estimated value of an asset at the end of its useful period or its lease term. It is advised to value the asset after considering its residual value. Number 2. Deal tenure. Lease contracts are tenure based and may not have liquidity options for early exits. Usually the contracts last for years. Thus, it is really important to take a look at the tenure of the deal before investing in the leased asset. And finally, it goes without saying, we need to thoroughly analyze the financial statements of these companies before making any of the investments. So now that you know about investing in leased assets, here are few reasons why it makes a really good investment opportunity. First off, diversification. Since lease investing is not linked to the stock market, it provides diversification for those investors who mainly invest in equity. Market price fluctuation of the company that is leasing your asset has no effect on your return. Number 2. Stable returns. Some leased assets provide up to 20% of internal rate of return. Number 3. Strong collaterals. The money you invest in leasing is guarded by strong collateral. This means the asset that you are investing is secure and stable. Well, I'm sure now you know how to generate stable returns and have an idea of how lease investing works. If you learned something new, please like this video and share this with your friends and subscribe for more.